podcast where we provide valuable information to business owners and entrepreneurs. Today, we're joined by Ryan Cooley, who's a wealth advisor at Jacob William Advisory. Thank you for joining us. Greatly appreciate it, Ryan. It's good to have you on the show.
Well, my
So,
pleasure, Steve. Thanks for having me.
tell us a little bit about yourself. You're in the investing world. So, who is Ryan Cooley and how long have you been doing this?
Yeah, so I've been doing this for a little over 5 years now, and have been. My background is I have a degree in economics from University of Maryland and also an MBA, and work in the financial planning world as far as helping individuals plan for retirement and everything in between, and then off of that plan, then invest money accordingly so we can help that plan get to conclusion.
What's a typical investor client of yours profile? What are you looking for? Individuals, businesses? How's that? What's the focus here?
Yeah, we keep it really simple in that we work with folks that have a problem and need help and are willing to listen. And it's as simple as that. We can help solve any type of problem surrounding your financial picture. And the important part is someone who wants to be a part of the solution, but also really heed the advice that we give.
Mm-hmm. So I know that at the end of the day, I mean, you do work with individuals, you work with businesses, 401k plans, and high net worth, some that are potentially not as high net worth, but are interested in building net worth. But I think one of the great things about Jacob William Advisory also is your platform. It's just great. That platform of ability to put in not just your financial picture, right, on the investment side, but really all the expenses and really get a great financial overall picture and plan, right, that helps you build wealth over time. So
absolutely, we really, one of our hallmarks is we believe everything starts with a plan, and in order to invest appropriately, we need to understand where that individual wants to get to, because that then determines how the investments need to behave. And so it really all comes back to sticking to a plan and making sure you're thinking of everything, not just the investments or a certain portion. So it's a all-encompassing plan that we run and really try to impact all facets of life.
Well, speaking about plans, I don't know that anybody really planned for the change in administration that occurred, but I guess it's a good time to kind of jump in and talk about what is going to happen to the market. I know that we can't predict this. I know there's no guarantee, but looking at historical numbers, right? When there's a change in administration, what happens? What do you guys see as forecasting?
We going back through history, there is really not a huge impact on the market long term in any election. Sure, there will be certain sectors that are impacted due to certain positions that a cabinet will take or a president campaign will take, but nothing that really changes how we manage our investments. By large, a lot of that stuff is out of our control. In the market, it's going to go up and it's going to go down. And you're right, we don't have a crystal ball, so we don't know when. And so we like to work in the world of what we do know. And so we really manage risk more than we manage the investments. And it all has to do with back to when does that person need to access their money? What do they need to access it for and in which way? That plan that determines how we manage the money, as such. So when it comes to elections, we pay attention to them and we want to know what potential impacts there could be. But as a whole, they tend not to have the impact that we would like to think.
So the objective is really building just a great financial plan, right, for your client that is as minimally affected by the markets and events really in the world that just helps them build wealth over time.
Sure. It's really about time in the market and consistent returns over time. We don't believe in chasing the S&P 500 or trying to come up with a great return on any given day of the year, just because with that also comes the risk with that reward. And so we know that a more pragmatic approach and sticking to your plan and really understanding the level of risk that you need, that you are going to grow more wealth over time.
And so interest rates right now, right, are essentially at an all-time low. I mean, bonds as well, I think, are at an all-time low.
Yeah.
So how is that impacting the market? I mean, historically and today, how are those things impacting investors and impacting the way you guys develop your plans?
No, for retirees or folks entering into retirement right now, it does pose a challenge in that it takes away one of the ways that we really try to reduce risk or manage risk, and it while it does reduce risk, we're not getting the returns that you normally get when if the market's not doing as well. Usually, it's the bonds that will pick back up, and in this case, with the rates being so low, we're just not getting that help on the bond side. So it really comes down to sticking to a game plan as far as how do you manage risk. And there's other tools that are available, but not as easy as it used to be, where you would just change your mix between stocks and bonds and move into a more relatively a less risky investment lineup.
Are you seeing more money flowing into the market currently right now? I mean, it seems like there's the most amount of wealth out there, and maybe it's not even wealth. I mean, if you can share insight as to where's this money coming from?
Yeah, a lot of it is generational wealth. There is an exorbitant amount of money passing between the baby boomer generation as they kind of die off to the next generation. The wealth's out there, and one of the reasons I see that the market is as much as it is and money is getting into it, is not only do we not have the bond side of things, there's less opportunities to, the interest rates are taking away some of the opportunities, leaving the market being one of the few places that you do have opportunities for growth. The other thing is, we've noticed that really folks are looking at the market currently through rose-colored binoculars, we'll call it. They're really looking out past the pandemic, and even more so now that we have a vaccine, they really see the light at the end of the tunnel. So they know that there is an expiration date to this. So really the name of the game is, how much more impact is it going to be on our economy and on the businesses in general until that fix, that solution comes to fruition. And so that's really why we see the market behaving the way it is that folks have been looking past this, not really investing for this. And it's kind of indicative of something that really this hadn't, going, and it really all revolves around the coronavirus. It didn't have anything to do with our economy. It wasn't a fundamental. It wasn't, it wasn't anything broken within our system. It was an outside anomaly that, conventional wisdom says once we fix that problem, we should, get back to the way we were. And while that's not exactly true, for the most part, it is. And so I think that's the reason why you see so much investing in the market. And it's also being driven by just a few companies that are really benefiting currently, and more of your tech companies that are benefiting in this environment. And we look for that to change as we start to move out of this.
And are you seeing that there are more companies that are offering 401ks, right, to their employees, helping sort of drive that money into the market?
I don't know if that necessarily would impact it as much, because the other solution before, or the other tool that was used before that, were pensions, and it was still money that was invested. So I don't know if there's more money as a result. Maybe it's just six in one hand, half dozen the other, as far as how it shows up. It wasn't as though the money wasn't being invested. But to your point, with the advent of the 401ks, pensions are few and far between. And so it's more on the individual to invest their money as opposed to a company investing it on their behalf. And so that lends itself to some of the things we see in the market as far as volatility, things of that nature. Your individual investors tend to make more knee-jerk reactions, things of that nature. But as far as an influx of money, I'm not sure that that is exactly the reason why, but it could have an impact on it.
I think from one generation to another. We're talking about companies as well starting to set up retirement accounts for their employees, individuals realizing that Social Security, right, may or may not be what they thought it would be. I think so. So what I'm hearing from you is there's an active push for individuals to really take control and charge of their own future, and that's what's also driving part of this market success, as well as you said very eloquently, we're looking past, right, the pandemic, and all of the indicators are that we're pretty strong. So we just need to get out of this and continue growing the way that we have in the past.
Absolutely, and that's not to say we're out of the woods by any stretch of the means. We for the most part saw a V-shaped recovery, but only within the sectors that were able to open back up. And so it all, it got back to where we were to a point, and then it kind of, the market and the economy as a whole slowed down as a result. And so, you can kind of rationalize through that. There's certain sectors that haven't been able to open back up at all. A lot of your travel industry, service industries. And then there's industries that have opened back up, but not to the degree to where they are profitable. Most restaurants operating at 100%, the margins are tight, and it's a tough business to be in. And a lot of them are being asked to operate at 25%. Well, on paper, they're saying they're open, but they're not open. And so, that's a concern.
Are you able to share with us your thoughts on just sort of, what sectors are good sectors right now? And I'm not saying to invest in, but what sectors are not as affected by the COVID shutdown?
Sure. The tech industry seems to be doing well. So I mean, you can kind of think through that. Your Zooms, we're on a Google team, our Microsoft Teams doing this recording. So those type of companies are doing relatively well. Your Amazon. We've had to shift dramatically as far as how we purchase our products in this country and across the world. And so them being there has helped in a way get products to the consumer, but it's really shifted from your brick and mortar stores to online. And I think that was already was going to be the case, but it's been sped up dramatically as a result. So those companies are tending, they're doing well now. But my thoughts are that as we move out of this, that's when the other portions of the economy are going to start to really benefit as we move back to some sort of normalcy. And yes, that's where we see it now. Really the industries that are having a tough time right now are all your service industries. We moved to a majority of a product type of industry as opposed to service. You have to be in front of people for a lot of these jobs, and we're being told we can't be in front of people, so it's tough. And so that type of stuff. So your travel, your restaurants, that type of thing, but also healthcare has been taking a big hit just because the hospitals are so inundated with COVID that they're not able to perform their normal, elective surgeries, things that really make them profitable from a business standpoint. So it's tough.
And that's the shock, really, of you're in the middle of the pandemic, and it's the health industry that isn't doing well. So, right. In the end, right, it's about knowing or trying to figure out what's the most important, right? What's going to happen, whether it's technology, artificial intelligence, whether it's online shopping, whether it's retail, in-person shopping, whether it's hospitality, all that changes over time, right? So knowing and having an advisor, right, like you, making sure you've got your plan in place and, able to pivot when needed, but really having your eye on the ball, the long, right, play is really critical. So I appreciate your time. Thank
My
you for
pleasure.
the information. I know that our viewers are going to find it extremely valuable. Probably be assured a lot of things that you have said will help them, and hopefully they will be able to contact you. So if anybody needs to reach you, I know they can call you at 410-821-6724. And, Ryan, again, always a pleasure. Thank you so much for taking the time and helping educate our entrepreneurs.
Thank you, Steve. I appreciate it.